Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at 15 different companies that pay dividend. Right now, the way the markets are going right now, everybody's talking about dividends. Last 2 years, it was all about growth companies and the fact that you can 10x your money in here and there and buy teledocs and this company, that company, right? There's nothing wrong with these companies, but they don't pay you dividends, okay? Some of these companies didn't have any earnings or whatever. Right now, people are worried because there might be a recession, there might be bear markets, stocks are going down, things are not great. When something like that happens, the stocks are not going up, because remember, people want to make money, okay? Two ways: either price appreciation, so the stock goes up and then you sell it for higher price, or you get dividends and at the same time you get price appreciation. Right now, the price appreciation is a little bit worrying because the stocks are going down. As you can see, I'm down in some of these companies that I own in my portfolio. So what are people doing? They're buying dividend stocks, and all of a sudden dividend stocks are becoming a thing. In the last few years, right, so I was reading this article a couple of days ago, and it talks about two income-oriented strategies to protect and grow wealth in the market. And that was around basically January that it was released. And one of the ways they talk about is dividends. Okay, and dividends is obviously money to the shareholders and so on. They also talk about at some point, and here I think they talk about how important dividends are and whatever, and then they're talking about selecting best fit ETFs and so on. And again, as Muslims, you know, we're finding it difficult to find any ETF that basically tracks the whole market, because the market is basically full of stocks that are not Sharia compliant. So we have to be picky and so on. And in the long run, you will be better off with the ETFs instead of picking stocks like I am here. Okay, but I do own these ETFs in my portfolio. Okay, so that's and I added them recently, but I do actually enjoy picking stocks. So that's one of the things. So yeah, let's get started. So what I did then, I did a little bit of research. Okay, I went on different websites to find Dividend Kings. So I looked at all the Dividend Kings websites, sorry, companies. And then I did the same thing with the Dividend Aristocrats. So Dividend Kings are companies that have increased their dividends, okay, over 50 years. They basically increased their dividend for over 50 years. So every single year for 50 years, they have been increasing their dividend. What that tells me is these companies are solid. They have a cash flow, okay, and they are willing to give us some of their basically income. The next one is the Dividend Aristocrats. Again, same thing, but they have been increasing their dividends over 25 years. So Aristocrats are still, I own quite a lot of Aristocrats, not so many Kings. Okay, then the reason for that, because Aristocrats are still growing. Some Kings are still growing, some Dividend Kings are still growing, but Aristocrats tend to be like a companies that are still growing. So I looked at the list. Okay, there's a lot of companies in this list, and you can see this is how long these companies have been paying the dividends or increasing the dividends, and there's a long list there, some which you probably have seen, some of which you haven't seen. And then what I did was I looked at all of these companies and I said, okay, which ones are Sharia compliant? Okay, which ones out of these companies are number one, Sharia compliant, and number two, the two criteria that I'm looking at is 5-year growth rate of over 10%. So I want companies in those two lists, right? Kings and Dividend Aristocrats that have paid, or even some of them might be aristocrats, but they have maybe paid about 5 years or 10 years, whatever it is. I'm looking for companies, whether in the Kings list or the aristocrats or just generally pay dividend, that have increased their dividends 5 years over the growth rate of 10% or more. And then dividend safety, according to Simply Wall Street, of 70% or more, because that's what I'm comfortable with. It used to be about 60, but I think 70 will be a safe bet. Then I will show you how many years they've increased that dividend, and then I will show you, just as a bonus, whether these companies are at the moment a buy, sell, hold, whatever they are, okay, or undervalued, overvalued, fairly valued, whatever. That's the criteria, okay. So let's get started with the first stock. And the first company we're looking at is Lowe's. Okay, Lowe's is a company that I own in my portfolio, is in the consumer and discretionary or cyclicals. They have a dividend yield of 1.5%. They grew their dividends over the last 5 years about 18%. And that is very, very high. Okay, that's really like the top companies. Okay, there's only a couple of other companies that are doing better than this company. Dividend safety of 93%. Okay, what this tells me is, right, they've got a lot of cash. They're willing to give us some of that cash as a dividend, and their dividend safety is more than 70%, which tells me they are not going to cut their dividend anytime soon. In fact, you can look forward to it, a dividend increase instead of a dividend cut. And they have increased their dividends 59 years in a row. And at the moment, they are fairly valued, okay, according to Morningstar. So this is one of the businesses that I own. I know if I have this company in the next 5 years, I expect at least maybe 10 to 18% increase of their dividends. What that means, this is going to grow. Then that means they will pay me more cash. Then I can reinvest that in the business. And then that is how the snowball effect takes place. Okay. Next one is Abbott Laboratories. This is in the healthcare. It has 1.5%, just above 1.5% of dividend yield. In the last 5 years, they grew their dividend about 12%, safety of 71%, so they just meet the cap, and they have increased their dividend over 50 years. But at the moment, according to Morningstar, is a little bit overvalued. So you might have, if you own it, maybe hold it. If you don't own it, do the research and then maybe put it in your watch list and see if it comes down to a fair valued price. The next company we're looking at is A.O. Smith Corporation. This is in the industrial sector. They have 1.7% dividend yield. In the last 10 years, they have increased about 15%. Okay, with the cutoff is about 10%. They have increased it 15%. And then dividend safety of 99%. So that means they have a lot of free cash flow. They're not going to cut the dividends anytime soon, possibly increase it even further. Years increases, okay, is about 28 years in a row they have increased that. And they are fairly valued at the moment, okay, according to Morningstar. The next stock we're looking at is SPGI Global or SMB Global. This is the company that comes up with all the credit rating and all that stuff, is in the financial sector. The yield is quite low. One thing I want you to notice is, right, I am not focusing on dividend yield. If I did that, that means the dividend increases will not be as high and the safety will be lower. So it depends on your time frame, time horizon, whatever. If you have, say, another 20, 30 years to invest, right, in the stock market, then don't worry about the yield, okay? Just invest in, growth companies that you pay you dividends, that are solid business, that are going to be around for a long time, and they will increase those dividends in time. But if you're almost closer to retirement, then you have to worry about yield because you want income. Maybe you're looking for in the next 5 to 10 years, you'll retire in the next 5 to 10 years, and 1% dividend or less than 1% is not going to cut it for you. You're not going to make a lot of money that way. So then you need to look at stocks that pay at least 2 to 3%, 4%, if that's what you basically, is that for your basically time frame. So you really need to look at your time horizon and decide whether you've got 10 years, 20 years, or 5 years or whatever. And based on that, and remember, if the stock pays about, say, 3%, 4%, I'm sure the safety is not going to be as high and the growth is not going to be as much. Okay, so that's something that you need to think about. So looking at SPGI Global, we're looking at less than 1%. But they have grown, basically they've grown this dividends about 16%, 99% dividend safety. They've been increasing the dividends for 48 years. Even though it doesn't sound a lot, but 48 years of increasing that dividend is small, but they at least they're heading in the right direction. And again, when you look at their price appreciation, it will be massive. So all of these companies, especially Lowe's and SPGI, I've done a lot of research on these two companies. And when you look at their price appreciation, in about 10 years, 15 years ago, they were trading way less than where they are right now. So you get that price appreciation as well. The next company we're looking at is Automatic Data Processing Inc. This is a data processing company. I think they do a lot of the US, where they look at basically their salaries and all of that stuff and come up with all sorts of data for the government and so on. Okay, so it's 1.84% dividend yield, 12% dividend growth rate over the last 5 years, and then safety of 97%. And they have increased their dividends 46 years in a row, and they are fairly valued at the moment. Okay, so SPGI is also fairly valued at the moment. Okay, so quite a lot of these companies looks like it's actually fairly valued. Like, next one is Illinois Tools Works. Now this one is got 2% dividend, over 2%, 2.26% dividend, is in the industrial sector. They have increased their dividend over 14% over the last 5 years. Okay, safety of 81%, which is very good. And then for 50 years, they have been increasing their dividend, and they are fairly valued at the moment. Okay, now the next company we're looking at is, if I can get this, Stryker. Okay, Stryker is in the healthcare, 1% dividend yield, and then 11% of dividend growth in the last 5 years. Dividend safety of 90%, and they have basically been growing these dividends of basically 30 years in a row, and it's 40% premium at the moment. So that means it's really expensive. Another company that is very similar to this company is Medtronic. They both basically sell healthcare equipments. Okay, and if you're interested, Medtronic is probably cheaper. So last video that I did was actually, it was on that list of companies that I've analyzed, so you can check that out. So it's very similar to that one, but it's a great company as well. The next one is Air Products and Chemicals. This is stock that I own in my portfolio. It's in the material sector. Okay, they do a lot of different gases, industrial gases, 2.57%, which is really high. 11% of growth in terms of the last 5 years, and then 95%. So I don't expect any cut anytime soon. I'm expecting it to grow this, and they're already paying me 2.57% as a dividend, which is really good. 39 years of paying that. Right now is 24% discounted. So again, it's solid business. I've been adding to it in the last few weeks, and I'm going to continue doing that while I still have the chance to do so before it becomes overvalued very soon. Visa is the next company. Again, like I said, if your time horizon is the next 5 years, you're going to retire, then Visa is not a great company to own if you're looking for a dividend income. But right now, they pay 0.67% in dividend. They have increased their dividend in the 15% in the last 5 years, and 99% of dividend in safety, and 14 years of paying that, and they are fairly valued at the moment. The next one is Home Depot. Okay, this is the home improvement sector and the consumer cyclicals, or discretionary, whatever you want to call it. The dividend is quite high, which is good. But look at the growth, 18% in the last 5 years, 87%. Okay, that shows me there's no cut coming in anytime soon. And hopefully, if they can do the same or even better in the next 5 years, I'll be very happy, man. And I'm going to hold on to this business for a long time. 34 years of dividend growth streak, and then but right now is actually 33% premium according to Simply Wall Street. Okay, so it's a little bit pricey. The next one is Union Pacific. Is another company that I own. Is an industrial, is railroad company. Right now, when you look at their dividends, 1.71, 14% growth in the last 5 years, 88% dividend safety. 23 years in a row they have been increasing, but they are really expensive right now. Genuinely, I wouldn't touch it right now. This company, I love it, I own it. I don't know, I think I've got like 12 shares or whatever it is, worth about over £2,000. I'm getting really good dividends. I'm going to keep on adding to it if it comes down, but right now I'm not touching it. The next one is KLA, so a company that I own in my portfolio. It is in the information sector or semiconductor equipment side of things. They have a small dividend, 1.11%, 12 years of 12% growth in the last 5 years, 71% just to meet the cut. Okay, 71% dividend safety, 16 years of paying that. They are fairly valued at the moment. The next company we're looking at is Williams-Sonoma. This is the company that I've analyzed in the last video, so check that out if you haven't looked at that yet. They pay 2.1% and 15% dividend yield, 12% of growth, basically growth in the last 5 years, 80% dividend safety, 15 years of paying that dividend, and right now they're 31% discounted. It's really cheap in my opinion. Okay, I would not be surprised if I see this stock. The more I look at it, the more I'm like, why am I not investing in this business yet? Okay, so we'll see what happens. Next one, questionable. Some people will say, why have you included Nike or Nike, whatever you want to call it, because of the situation in China? But I don't know if that's now completely and utterly sorted or whatever from their perspective anyway. Just make dua for those brothers and sisters in China. But at the moment, the company is basically growing their dividend quite a lot, so 12%. The yield is very, very low, okay, but they have 99% dividend safety, which is the reason I've included them here. And obviously 12% dividend growth in the last 5 years, 37 years of increasing that dividend. I didn't think they were almost dividend aristocrat. They're going to go into the dividend kings very soon. Right, the next one is Canadian National Railway. Okay, they are very similar to Union Pacific. Okay, so the railroad industrial company, 1.71% and 10% growth in the last 5 years, 97% dividend safety. I think this is the company, what's his name? Bill Gates owns in his portfolio. For the foundation that he has, and then 97% dividend safety and 25 years of paying that. Right now, really expensive, just like Union Pacific. They are very, very similar. They are being up quite a bit, and that is 15 different stocks that have high growth in terms of the last 5 years, so 10% or more. They have dividend safety greater than 70%. They have been increasing their dividend for a very long time. And this is the kind of companies that you can buy and forget about. And if it goes down, you get happier and you actually add to it. Because you know you can sleep well at night knowing that you're going to get these dividends. Because they still grow in the dividend as well, companies like Lowe's will actually go up in price. So right now, as you can see, I'm up about 10%, 11%, while I'm basically up. At the same time, I'm getting paid some dividends. KLA is another company, okay, that I own in my portfolio, up almost 8%, but at the same time, I'm getting paid while I sleep. Same goes for Home Depot, same goes Medtronics that I mentioned earlier, okay. All of these companies that we just looked at is companies that you can just buy and forget about. Okay, and just add to it every single month. And this is what you need in this kind of market. You don't want to be checking your portfolio every second. And you want to buy quality companies that have a great dividends, okay? And again, people hate dividends for whatever reason. In the last 2 years, they became like a taboo. No one talked about it. But right now, everyone wants to talk about it simply because they realized, you know what, where am I going to get money from? I need cash. Therefore, what are they doing? They're investing in dividend stocks. Okay, so if you're already a dividend investor and you own some of the companies that I've talked about, put it in the comment section. Let me know what companies you own. Okay, I'm really interested to see what people own. So please, if you watched this video for like 20 minutes now, please just write down some of the companies that you own in your portfolio, good or bad. I don't really care. I'm not judging. I just want to see the companies that you own in your portfolio, and obviously it helps the whole community. And then you can suggest some videos that we can look at, inshallah, next time. There's a couple of brothers that have been suggesting loads of different videos. Inshallah, once my voice is completely back, I will be doing some more videos on just looking at those companies that you suggest, inshallah. If you enjoy this kind of content, please like the videos. That's all I ask. Okay, take care. Assalamu Alaikum. Bye bye.